Here's our economic update for October 1st, 2025. So for interest, on September 17th, the FOMC met and they decided to reduce the interest rate by 0.25%, so a 0.25% cut. And now we're at 4 to 4.25 for overnight Fed rates funds. If you're wondering what's going to happen with mortgages, they are coming down, but the Fed funds rate is more of short-term rates, not 30-year or 10-year rates, but they are coming down at the same time. So for 30-year mortgages, what we've seen is it's come down from about 6.75% down to about 6.3%. One thing to be concerned with here is if you have the 10-year minus the short rate, the 2-year, this has now climbed to over 0.5%. Generally, when you go through an inversion of the 10 and 2 yield curve, it indicates a recession occurring sometime in the near future, sometimes 12 to 18 months. It's been stretched out this time, so it's a lot longer than it typically would be. So once you go above about 0.5%, if you look back through history, after hitting a yield inversion, typically that's the onset of a recession. So we'll see if that happens or not. So some of the main reasons that the FOMC made the decision to reduce by 0.25% is they're seeing moderation of economic growth, meaning slowing of economic growth. They're seeing unemployment is going up, but they're stating that it's still relatively low, historically speaking. And inflation remains high, which is preventing them from having deeper cuts. So when they had this 0.25% interest rate cut, there was one dissenting view. They wanted a 0.5% interest rate cut. So for jobs, at the end of September, we had our JOLTS report. We have 7.2 million open jobs. It's slightly up from the last month, but overall, the trend has been downward for the last couple of years. Leave in the comments below how many jobs of that 7.2 are actually real jobs versus ghost jobs that they just have open, but nobody's actually hiring for. Good news is layoffs still remain relatively low. They haven't really ticked up considerably. They're up a little bit, but nothing major at the moment. In the second quarter, a third of CEOs did say that they're looking to reduce their workforce over the next 12 months, so that's a little bit concerning. On September 5th, we had our jobs report. There are now 7.4 million people unemployed looking for work. And if you think about that, there's 7.4 million people without a job, but there's only potentially 7.2 million jobs that are looking to hire somebody. So now we have more unemployed people than we have jobs available. So the unemployment rate is 4.3%. This has been going up slightly. It's not a huge increase, but it is in the wrong direction. Historically speaking, unemployment is still relatively low. The concern here is that young people entering the workforce, 16 to 19 years old, they're having a bigger problem finding work at the moment and just people without experience in general. The other issue that we're seeing is African American unemployment is now at about 7.5%, and that's going up in the wrong direction. These two groups tend to go up before the other groups, which are early indicators of you may be entering more of a recession or maybe an economic slowdown. The other one is the average hours worked has been going down in recent months, so that's in the wrong direction. We've only averaged about 27,000 jobs each and every month on average over the last 4 months, and we actually went negative job creation in June, so that was the first time since 2021. We're not going to get any more economic data until the shutdown is done. I was trying to wait till October 3rd when I could give the other update for the jobs numbers, but that if it's still shut down, I'm not going to get that data. That also causes an issue for the FOMC. They're supposed to meet on October 29th and make a decision based on data whether or not they should reduce rates further. Right now, it looks like they'll have another 0.25% interest rate cut and then the same in December. So we're looking at 2 more cuts by the end of the year. But if unemployment goes higher or the labor market is deteriorating quicker, they may have to make bigger cuts sooner. But without that data, they're going to be flying blind. On September 9th, jobs were revised down by 911,000 jobs that are just not in existence that we thought were in existence. And that was March 2024 through March 2025. That's a new record, worse than 2009. So that's the worst on record that they have so far. For inflation, September 11th, we have our consumer price index at 2.9%, our consumer price index core, which excludes basically energy and food costs, it's at 3.1%. On September 10th, we got our Producers Price Index. Basically, it's 2.6%, and Core, which is 2.8%. I thought it was interesting that they also now exclude trade services as well as the food and energy costs. So I don't know if that's basically because of tariffs. On September 17th, there's the personal consumption expenditures of 2.7% and Core, which is 2.9%. All of these numbers, why they're highlighted in red, basically we have a goal of 2% inflation, and the preferred FOMC measure of inflation is PCE. So we're at 2.7 and 2.9 for Core. So it's still elevated, which comes back to inflation remains high. How's the consumer doing? Well, September 30th, we have the Consumer Confidence Index. We're at 94.2. That's down. Consumer expectation is down. It's at 73.4. So anything below 80 here typically indicates a recession is ahead in the next 12 months. We've been seeing this since February of 2025. On September 17th, the consumer spending, which is about 70% of the U.S. economy, was up 129.2 billion. So that's good. Up. Personal income is up 95.7 billion. Retail sales are up about 4.8% year over year. So those are all good. Now, the question I always ask myself is, if you are spending more than you are making, where's the money coming from? With this, a lot of this is actually coming from the top 10% of earners. Most of the people are living paycheck to paycheck, and if they need to pull out more money or pay for additional bills, we're seeing people starting to scale back on subscriptions, not buying as much in terms of brands and going to off brands for food. And we're also seeing an increased rate of defaults and drops in credit scores. There's also the buy now, pay later, which will start hitting people's credit reports in the coming months. Yes, spending is up, but remember, people don't care if it's credit or if it's actual income and cash that people are spending when they're looking at these numbers. So you have to remember people are starting to default, and credit delinquencies are up, credit card delinquencies are up. So people are borrowing, but they're defaulting on a lot of that borrowing as well. So we have our consumer survey from Michigan. That was September 26th. Sentiment is down 21% over the year. So current economic conditions are down 4.6% year over year, and the consumer expectations are down 30.5% year over year, so all in the wrong direction. So this usually leads into what people will eventually spend. So we'll see what happens over the next couple of months, especially going into the holidays. So GDP for the US on the 25th and 26th of September, we got revisions. For first quarter 2025, we're at negative 0.6%. That used to be minus 0.5%, so it's gone down further. Second quarter 2025, we have gone up to 3.8%, so that was a very big rebound. And for third quarter of 2025, this is estimated at 3.9%. So these two are really good rebounds in regards to economic activity. So hopefully that continues and it keeps us out of stagflation and keeps us out of a recession. Do realize that the only people that can call a recession officially is the National Bureau of Economic Research, and they've changed the definition a few years ago. It used to be 2 negative quarters of GDP. They've since changed that definition so basically you have to now have depth in at least one of the categories, basically unemployment, GDP, some other things. I'll put it up here. And it has to be broad, so it has to go across the economy for more than a couple of months in order to be called a recession. And they usually have to wait many months after a recession actually occurs until they actually call it a recession. So that might be 6-12 months later. So currently what we're seeing is 21 states are either in or at high risk of a recession. And then New York and California are still stable. So that's good because they account for about 20% of the US economy. Texas is still growing, and that's about 9% of the economy. So with that, you have almost 30% of the US economy either stable or growing. Also recognize that the economy is not the stock market. People can have a job loss while the company can actually increase its profit. A company could lay off workers, reduce its costs, find different ways of increasing productivity. Right now, people are looking into a lot of AI, and that could help boost profit because you've reduced your costs or you've increased your production. The unemployment rate is always lowest going into a recession and typically peaks several months after the recession. A stock market generally bottoms about 6 months prior to the unemployment peaking. So even though unemployment could be going up at certain times, the stock market may actually start going up with unemployment going up towards the end of a recession. Also realize that because the stock market is based more on company profits and forward looking, a company that lays off tens of thousands of workers, reduce costs, increase productivity, and therefore increase profit could actually continue to go up even during a recession or those types of periods. Now, if a lot of companies start laying people off and there's a jump in unemployment and those people can no longer continue spending, being that 70% of our economy is based on consumer spending, then yes, typically the stock market goes down during a recession. During bouts of high inflation, what you may see is stocks and other asset prices may be going up, but the inflation is eating away at the value during a recession. So we have our leading economic indicators. September 18th, the US leading economic indicators have further declined. This is now 6 months that we've gotten a recession signal. So the reason for the decline was stated that basically there's negative consumer expectations. For manufacturing, there's less and less new orders, and housing permits are not being pulled as much as they used to be. And the reason with the housing permits is we have basically a glut of housing that are new houses. So then if we have like 9 months worth of new housing supply and 6 months is basically a balanced market between buyers and sellers, why would you build any more houses if people are not buying houses? Also, if people are net immigrating out of the US or being pulled away from certain areas, like mostly in the South or in the Southwest, you may not have as much demand for housing. So that's something to look at. Whereas existing housing, we have a little over a 4-month supply. And with that, there's still pretty good demand in the Northeast and the Midwest. But again, in the South and the Southwest, there's not as much demand. So you may see housing prices starting to drop in those regions. Remember that all real estate is very local, and you may see certain areas that are doing well and then other areas that are not doing as well. From some of the viewers, they were asking for economic data from outside the US. So the Eurozone, the leading economic indicators, they're showing that there's a recession warning. I have links in the description below that you can actually go into here and look at the detailed reports with these as well. And China, the leading economic indicators, they're showing recession signals. However, if you look at India, the leading economic indicators, they've been showing growth for many years and continue on that path. A couple of recent events. So on September 21st, the US announced that there's now a $100,000 per year per person for an H-1B visa. This is really going to start to hurt US tech, engineering, programming, things like that. So I understand why this is being done. It's meant to protect US jobs and make sure that the unemployment rate, especially in tech, doesn't go up. But the problem is that if you have special skills from outside the US and you want to have those companies grow quicker, you can import basically those skills by allowing for H-1B visas. I don't know what's going to happen with this, and I don't know if the US courts are going to allow this. There's a few things that are being put through the courts at the moment. But that just happened, so we'll see how that shakes out. So speaking about courts, there was a 7-4 decision on September 3rd, September 4th, basically that the US tariffs were ruled illegal in most countries. The only exceptions would be the ones that are imposed on China, aluminum, steel, and automotive parts. This is going to move back to the US Supreme Court. If this holds, effectively October 12th, tariffs would be taken off of those countries, and the US may have to reimburse people for imports. So we'll see how that works. October 29th, the FOMC, there's going to be another meeting, and I believe that there will be a 0.25% interest rate reduction. October 1st, the US government shut down, so we're pausing all economic data. So I'm going to wait to give more updates until we actually have data, because I want to talk about data, not just feelings. At the end of September, the EV credit expired now, so there's no longer a $7,500 credit from the federal government for purchasing of electric vehicles. So if you notice Tesla stock going down recently, that's pretty much a big part of it. So with all of this information, what am I doing? Well, I'm still dollar cost averaging, investing mostly into the S&P 500, about 70 to 80% of everything I put away each month. And then about 10 to 20% I'll put into a international fund. And then I also have about 10% bonds at the moment, looking that as interest rates drop, effectively the bond value goes up. That's the only reason why. And then if there's a drop in interest rates, which we're starting to drop interest rates, that's typically when I see a boost in the value of bonds. People also ask, what about gold and silver? I'm not currently investing more money in gold and silver, but I do have over $100,000 in gold and silver. I'm just holding on to that. The last time I sold that was, I think it was like 2011 when silver was over $40 an ounce. I sold it off and then I bought it back when it was $15 an ounce. Right now it's kind of going back up into that range, but I'm going to hold on to gold and silver for at least the foreseeable future. Thank you for watching. Please subscribe. If you want to see more content on how to make more money, how to save, how to invest, how to be an entrepreneur, this is the channel for you. Thank you for watching. Have a great day.